Once again, good afternoon. This is Kathy Neifeld with Agency One, and I am pleased to be bringing you the continuation of our weekly webinar series. Today is Tuesday, July 14th, and today we're going to be talking about guarantees. Everybody is looking for guarantees in a market where the only thing we're faced with right now is uncertainty. Our friends at Prudential have put together a phenomenal presentation and platform to be able to offer your clients guarantees in this uncertain marketplace. And I am pleased to be bringing you today two phenomenal speakers from Prudential. They've been longtime employees of Prudential. The first one is Brett Berg, who is the Vice President of Advanced Planning. He's been there for about 10 years and has 20 plus years advanced planning experience. Joining him is Joseph Peterson, who is the Director of Investment and Variable Product Distribution with Pro, and he's also been there about 10 years. We may be able to, if we have time, hear from Tim Eads, who is our regional VP with also significant experience with Prudential and in the life insurance space. He's going to be talking about some solutions that are available once your products are put in force. And then we are absolutely going to be hearing from Dennis Bartos, partner and chief underwriter with Agency One, to round out the presentation. If you've got any questions, please remember to type them into the chat box and we will address them when they are proffered or at the end of the presentation, depending upon when we feel that there's a natural break. So without further ado, I am going to turn this over to Brett to kick the presentation off. And Brett, thank you for joining us and take it away.
Well, thank you. And thanks to Agency One. Thank you everyone for joining us. I'm going to tee up the discussion today with a presentation that we call Complete the Dream. And here's the point. When you're talking to clients, they've worked decades to save up for their nest egg, and then all of a sudden, a black swan event happens, and the legacy that they've prepared for may not be the legacy that they're looking at in terms of leaving their children. Surprise happens. It's like this COVID environment, but also it was like the financial crisis environment that we had. It can be any kind of black swan event that really catches their attention. And certainly we're in one of those situations today. So today we're going to talk about the market volatility, the uncertainty that people face, the risks that are associated with that. And then one of the strategies that you can explore with your clients, investigate with your clients to offset that volatility, to manage those risks. And today I'm going to focus on a strategy, and you're going to see an example that uses variable universal life as the product solution. Certainly any insurance product could be used in one way or another to manage these risks. Please take this as one example of how you can approach the market. I like to focus more on the concept versus the product because I think the concept is what catches attention, is what grabs attention, is what focuses the client. So let's focus the client on market volatility, which is something we've experienced recently. You know, this is a chart that shows the past bear markets, what's happened over time when we've experienced those bear markets, anything from the Cuban Missile Crisis to the oil embargo to Black Monday in 1987, the global financial crisis that we experienced in 2008, and now this COVID outbreak that we've had recently. And certainly we experience these bear markets and we know about these bear markets, but it's when we go through that bear market, when we see that recent slide, and this is the slide from February 19th to March 23rd of this year. I know the market's rebounded, but the whole concept is we face uncertainty in the market, we face market decline. And when we do, we try, and financial advisors always try, whether you're advising the clients themselves or working with other advisors that are advising the clients, to manage their emotions during upturns and downturns. But what we know is that not everybody acts rationally during a market decline. Some people many people, unfortunately, sell low because of what they're going through in terms of their emotions. And so certainly there are ways to manage investment behavior and market risks and market downturns that have to do with investment management, but we do face some challenges with that with respect to managing the client behavior. And it can take a long time for a client to recover from a bear market. Take a look at this slide. How long will it take a portfolio that loses 25% of its value to return to that initial amount, especially given the fact, and remember the previous slide where people may sell low, they may flee to safety after they've lost money. Flight to safety may mean the portfolio never recovers. Look at the chart. Based upon varying net rates of return, it shows you the number of years that it would take this person to recover those losses. So we face this market volatility and these risks, and we know that staying the course is something that people should do, should consider. We've seen great market upturns after we've had downturns. That's the purpose of this slide, to show that. So there are ways of managing this behavior besides what I'm going to show you, which is a life insurance solution. So what I want to get across here is that this has to be put into context. Life insurance is not the only solution to help people during these times. We also have to help them just manage their investment behavior in general, stay invested where it makes sense, et cetera, and so forth. If we're advising them on their investments, or if we're advising them with respect to their financial planning and their overall picture, make sure that we're putting this all into context for them so that they use all the tools in their tool belt to manage these situations. They do face all of these risks, though, and one of the risks that they face that I haven't talked about yet are taxes. And what this graph shows basically is it shows hypothetical growth of a $100,000 non-qualified investment at 8%, assuming a 40% tax rate. Now, if we take this hypothetical investment and we assume that it grows at 8%, we can see that the accumulated value at the end of year 30 is $1 million with an IRR of about 8%. Now, if that were a tax-deferred investment, the light blue shows you if it wasn't taxed at all. The next shade of blue shows you if it were tax-deferred, right? And we had to liquidate that amount at year 30, assuming a 40% tax rate, we would have $643,759. That's the calculation. So the IRR would decline from 8% to 6.4% based upon a liquidation at the end of the term. And the darker blue there shows you if it were taxed over time, a taxable investment, we would only have a value of about $408,000 with an IRR of 4.8%. So here's the point. The lower the rate of return as it's eroded by the taxes means that it will take longer to recover from the market downturn. So this taxation compounds our market volatility problem and our risk that we face that way at a minimum. And you can see the IRRs shown there based upon the different assumptions in the slide. Not only that, but we have legislative changes that we have to take into account. We have to think about these. We don't know how long the Tax Cuts and Jobs Act will actually be in force. We know that it sunsets after 2025, but what about a change in the presidency, for example, and compound that with a change in Congress? We don't know if that's going to happen, but we need to help clients manage these situations, help them think this through, help them think through their strategies to help them ensure that they implement the certainty that they can, even in an uncertain environment. That's my message today, is that clients need to take control of their own situations and provide certainty within their context, what's within their control the controllables, even in an environment that may seem uncertain and is uncertain, and may seem even more uncertain given the possible legislative changes that we may have after the election. Not only that, but we have chronic illness risks. And this slide really shows you a lot of the statistics around chronic illness and the risks that we face. And here's my point around this, is that chronic illness sometimes forces people into a situation where they have to liquidate money to pay for an expense such as chronic illness that they didn't want to. Maybe they expected it, maybe intellectually they knew the risk, but when they're faced with the actual risk and perhaps having to liquidate, $80,000, $100,000 worth of their portfolio assets in a down market, think about what that can cost them. Think about what it can cost them in terms of money, in terms of opportunity costs, in terms of just devastating their portfolio investments. It can happen to people. They need to be prepared for the eventuality that they may have chronic illness expenses. And that's another risk that we have to just take into account when we're planning for clients. And these sequence of return charts, the point of these, my next two slides, is to show you that during an accumulation phase, when you take the money out really doesn't affect it, assuming that we have the average rates of return the same, if you take it out at the beginning or take it out at the end. If you're in the accumulation phase, if you're not withdrawing, we have the same amount of money. Mathematically, that makes sense. But if we're in a decumulation phase, it matters a lot. When people start taking money in a down market, it dramatically or may dramatically and almost always will dramatically affect their net number that they will achieve over the same net 10-year period. These numbers bear that out. And it just makes sense. If I'm liquidating in a down position, I have less money invested, less growth, etc. So what we're trying to do with people are manage all of these risks, help them understand what their risks are, help them understand that they need to manage their product selection and their product portfolio just like they do their investment portfolio, so that they are tax diversified and diversify their product selection and product features so that they can manage these risks better when they do face them. So here's the strategy. This is called Complete the Dream. And if I were talking to clients, I might say, what if you could help remove the impact of market volatility, help counter the losses and volatility you may have experienced during the recent downturn or a recent downturn, preserve and potentially increase the ultimate value received by the heirs, grow money tax deferred, and the heirs will receive an income tax-free death benefit. And you may even add riders that accelerate the payments in the event of chronic illness. And you could do all of the above on a predictable and guaranteed basis. These are the benefits that people may achieve through this strategy. Acquainting them with these benefits, I think, is a very important step. And then we launch into, okay, if you're interested in these benefits or many of these benefits, we have a strategy called Complete the Dream. Here we're using VUL Protector. We could use other products in our portfolio. Agency One has access to all the products in the marketplace. So whatever product makes sense, we should really focus on the product, although VUL Protector is a great product and a great example. So that's why we're focusing on it today. VUL Protector can help the client restore the value that may have been lost due to the recent downturn in terms of the death benefit, right? Putting a death benefit there. Reduce downside protection by avoiding market volatility via a guaranteed death benefit. That's what's important to remember about a product like VUL Protector, is that it not only invests money in sub-accounts, and Joe will launch into all the product specifics with you, but it also has a guaranteed death benefit. The assets stay invested in the market to maintain an upside potential, It allows that market participation to potentially increase their legacy, right, with an option B death benefit type of a scenario. And it implements a contingency strategy that addresses growing concerns about the financial impact of chronic illness. It can, with the addition of our BenefitAccess Rider, which is our chronic illness rider. So here's the strategy in a graphic form. What we do is we take those legacy assets, those never assets, the never money that people aren't ever going to use for retirement income purposes or anything else. It was what they were going to leave to their kids in the first place. And we say, we're going to reposition part or all of that as premium towards a life insurance contract. Here, the example is VUL Protector, but it could be our SUL Protector product. It could be a survivorship product. It may be a fixed index product. Let's be product agnostic. We are repositioning their legacy assets, part or all, to life insurance. It's going to leave that net death benefit to the children. The balance of the legacy assets that they don't use for the premium will go to their children. And when they take a withdrawal of their legacy assets, they may have some income tax due. It depends on what the asset is. If it's an IRA asset, of course they have to pay income taxes to the government on that, but it depends upon the asset. So what we're trying to do here is say, look, you've lost money in the market. Let's reposition life insurance. Let's help you recover what you had in terms of your legacy. And let's do so, in this case, on a guaranteed basis and allow you to remain invested in the market in equity subaccounts of a variable policy. And we can also add a chronic illness rider that allows them to accelerate the death benefit in the event that they qualify under the terms of the rider. Can't do 2 out of the 6 ADLs or have a cognitive impairment, likely to last a lifetime, for example. So if we do this repositioning, this shows you what people can do. Okay, so if I were talking to a client, I would say, all right, you had $1 million, you lost 25%, you've got $750,000. Do you want to reposition it all in a single premium? If so, you see the guaranteed death benefit there to age 120 on VUL Protector is a little over 1.1 million. Maybe they don't want to do that. Maybe they don't want to take the whole 750 and do a single premium. They don't have to. $250,000 of premium in a 3-pay gets them $1.2 million in the scenarios that we ran for this presentation. And maybe they don't want to reposition all of it. Maybe they just want to position part of it, half of it. That's the third example, taking $125,000 for 3 years and getting a total guaranteed death benefit of $600,000. Now, you say, well, Brett, that doesn't get them back to the million that they had, that third example. No, it doesn't, but it gets them more than halfway there. And remember, they still have the other legacy assets, what they don't reposition, that are going to go to the heirs as well. So it gets them almost back to whole in that example. It all depends upon their tolerance for repositioning the assets. It depends upon their situation. It depends upon their outlook. It depends upon the product that you're using. A lot depends upon the conversation that you're having with your clients. The goal here is to say, this is the opportunity. Let's put you back into a position where you're giving the legacy that you thought you were going to give. We can do that with life insurance, with the power of life insurance, and we can design it in whatever way you want to. This is an important message. This is a powerful message for people to hear. And we see the death benefits at age 90 based upon the illustrations that we've developed as well. It's not just what they put in today and what the death benefit is now, but depending upon what kind of death benefit they're designing, they could have a lot more death benefit at various ages. So the BenefitAccess Rider, I talked about that. That's our chronic illness rider. It's not the only chronic illness or long-term care rider out on the market, but this is how the BenefitAccess Rider works. And if you're interested in that, Tim can get you information. Agency One can get you information on that, on how it works. The power of this, the bottom line here, is that life insurance does more. It's not just about the death benefit. It's not just about the guaranteed death benefit. It's not to the heirs. It's not just about the cash value that can accumulate or be distributed through withdrawals and loans from the equity subaccounts in a variable product or in the fixed accounts of a fixed product. It's also about accelerating the death benefit for chronic illness payments. That means that people may not have to liquidate other positions in a down market. It really helps them address the market volatility and sequence of return risks that I talked about before. The strategy with the BenefitAccess Rider, it does have a cost. If you add the BenefitAccess Rider, you can see in the different scenarios that we had, and I'm not going to read through all these different scenarios, but you can see, for example, on the one pay example, if I had BenefitAccess Rider, I had $1.1 million worth of death benefit. If in this scenario that we illustrated, I added the BenefitAccess Rider for the same amount of premium, I would have a little over $1 million of death benefit. So there is a cost to the BenefitAccess Rider, and you can see that cost and you can see it play out in the illustrations. The bottom line is we want people to have options. We want people to make their own choices. We want people to take control of their situations and provide certainty in the midst of uncertainty. And we can help them do that with this strategy. So today we've talked about market volatility and the other risks associated with planning and what people face. And the bottom line to me is that people have faced this risk. They've lived it. They know it. They know, and it's very visceral. It's very real to them. And they know about tax risk, they know about chronic illness risk, they may know about sequence of return risk, and you can help them understand all these risks. And one of the strategies available to them to help them manage this risk in a very powerful way, put the amount of legacy back where they thought it would be, do so in a guaranteed way, and have all the other benefits that we've talked about during this presentation. We can help in many ways. As we can be helpful, we look forward to doing that. We have many different market pieces on this. As we can be helpful to you, we look forward to doing that. So beginning the conversation, obviously you can talk to existing clients and profile clients that have gone through this situation. Use your networks of CPAs and other attorneys and so forth to engage them in conversations about people they know that are facing these problems. And obviously approach new clients with this as a new way, perhaps to them, of managing these risks in this very important time. So with that, I'm going to turn it over, back over, and I think Joe is going to talk a little bit more and drill down more on the product side of what we offer, not only from a VUL protector standpoint, but from a fixed product standpoint as well.
Joe, I think you're on mute.
My apologies. I think we're all set now. Kathy, can you confirm that this is showing up on the screen okay?
Yes, I see it fine. Thank you.
Perfect. Thank you. All right, then thank you, Kathy. Thank you, Brett. And good afternoon, everybody. I want to echo one thing that Brett said a number of times throughout his prepared remarks, which is we focused in that particular presentation on one product, which I'm going to elaborate upon, but really the concept could apply to any of our solutions. So what we have before us here is a brochure, which is our product portfolio guide. As you may notice, it is 17 pages in length. I promise you, I'm not going to go through all 17 pages. But for those of you that maybe are not familiar with this, this is a wonderful resource either for you or the folks with whom you partner at Agency One. This really walks through all of our different solutions, some of the most salient information about them. It shows you a matrix of the different riders that we offer and which products they're available on. Obviously, BenefitAccess Rider is one that we mentioned a number of times, and even some of the common sales strategies that are associated with these different products. So again, an absolutely wonderful resource guide. The reason I like to start with this particular piece is for this visual right here. This is our suite of solutions that are available from us at Prudential, arranged in a hypothetical risk-return spectrum. So to Brett's point, any one of these could in theory be used with that complete the dream concept. You can start all the way in what I'll call the southwest quadrant down here, which is our term suite, then moving on to our guaranteed universal life through our index solutions, and then on up to our variable products in the top northeast corner. And this is where I want to spend some time. Again, any of these solutions could be used with that concept or many of the others. But we wanted to focus some of our time today in demonstrating why we used VUL Protector in light of that presentation. Above and beyond just being a natural fit, given some of the commentary regarding the sequence of returns and market volatility, we have also taken over as the #1 manufacturer in the VUL marketplace. And because of that, we thought it'd be helpful for all of you to understand what we've done from a product standpoint that's allowed us to move into that space, and then some of the biggest competitive differentiators that have allowed many of your peers and colleagues to look at us so closely. So in this Northeast quadrant that we see here, the first thing that I want to point out is that we have separated out our two solutions. You'll see that we have our PruLife Custom Premier 2, and then sitting beneath that, we also have our VUL Protector and our SVUL Protector. For the benefit of anybody that may not be familiar, towards the latter part of 2019, we re-engineered our survivorship VUL Protector to essentially look, feel, and behave identically to our VUL Protector. So I'm going to talk about those two as if they are one solution, but they are in fact two different products, obviously differentiated by the number of lives that they cover. But I do want to call attention towards the fact that we have separated these out. This is arguably one of the biggest things that our industry has done in terms of the insurance manufacturers that's allowed VUL to gain so much market share in recent years after the dip that it experienced coming out of the 90s and into the early 2000s. After a lot of people experienced variable product lapse, whether it was because of the tech bubble, possibly even through the financial crisis, we saw variable universal life sales drop off dramatically about 10 years ago. We've seen that really a complete reversal in that in recent years, and much of that has been driven by this bifurcation of the broad product category. We now have where our PruLife Custom Premier fits in. This is our accumulation vehicle, and then where our VUL Protector fits in, this is our protection solution. And what we mean by that is the accumulation industry within VUL is where you're going to be overfunding these often over the course of 10, 20 years, up to maximum non-MEC amounts. And you're doing it for clients who maybe have a slightly lower death benefit need, but they have a greater need to try to inject as much cash into these policies as possible in order to take advantage of the tax treatment of it as an investment. The protection space is really more of that wealth transfer, deliberate death benefit design, and that's why that would fit into the concept that Brett just discussed with us, because these are truly about wealth transfer. The biggest innovation that this segment has seen has really been the advent of the no lapse guarantee. Said differently, what insurance companies have done is told people that as long as you do what the contract states, as long as you pay your premium on time in the amount specified for the number of years that we've agreed to, then your death benefit will be guaranteed to be available to your beneficiaries, regardless of what happens within the capital markets. Even if your cash value declines all the way to zero, that the death benefit is still guaranteed to be in effect. This bifurcation of the product category has really allowed not only us as manufacturers to be more deliberate in our product design, but it's allowed us to repatriate that value back to consumers and producers by making sure that we have products that are more aligned with what they're trying to deliver for their clients. In saying that, we here at Prudential have really taken this seriously. This is an area that we have put a lot of our time and energy towards, and it's allowed us to really become the #1 manufacturer within the VUL marketplace. And what I thought would be helpful to do today is to demonstrate some of the competitive differentiators that have allowed us to take over that spot. I want to focus those comments really on one area in particular, and that is our investment prowess. Before I close out my remarks today, I'll certainly add some color around a few of the others as well. But I do want to spend some time on our investment prowess because, in my humble opinion, this is the biggest differentiator from anybody else that you will find within this space. And I'm going to discuss this through the guise of our VUL Protector, but really these comments apply to any of our variable solutions. When you think about variable life insurance at the most foundational place, it truly is the intersection of life insurance and asset management. Right? These are solutions that have an insurance component to them, but they are also going to be completely influenced by the performance of the underlying investments. Therefore, in order to deliver the most competitive solutions in this marketplace, you need to be able to execute on both sides of the ledger. That's a very important point because when we think about the traditional insurance carriers, the traditional VUL manufacturers, most of them are wonderful insurance companies. What they are not, however, is an asset manager. for one reason or another, our broader financial services community, the manufacturers within it, have tended to fall on one side of the coin or the other. They tend to be insurance companies that manufacture life and annuity products, or they tend to be asset managers that manufacture mutual funds and ETFs and managed accounts and other similar solutions. Prudential is possibly, in my opinion, the single largest outlier in that regard, because we are not only a top 5 insurance company in the world, but we are also a top 10 asset manager in the world. So when we manufacture insurance solutions, it's important that we make sure that we competitively price our no-lapse guarantees like we just talked about. But it's also important that we don't do it at the expense of the investment component. And I think that the brochure that I'm going to walk through will help to demonstrate this a little bit further. So this, unlike the last one that we just looked at, this is in fact a client-approved brochure. So for those of you that are interacting directly with consumers, either in an advisory or in a point-of-sale format, this is a brochure that you can in fact use with them. So if you're sitting across the table from a consumer, it starts off with traditional product copy that is targeted towards a consumer. Things like, why would I choose VUL? Why are the investments important to focus on? And why should I consider Prudential? From there, it moves on to bring in an introduction of our Strategic Investment Research Group, or as we colloquially call SURGE. We bring this up because this is arguably the biggest demonstration of our investment prowess and why it's so differentiated compared to other insurance companies that you may be considering. Most other insurance companies have to contract this function out to a third party. For any myriad of reasons, this is a capability that is rarely embedded inside of an insurance company, but again, Prudential is an outlier in that regard. SURGE is the group that is helping us to assemble, monitor, and if necessary, fire the asset managers that we make available within our variable products. And that's true not only of our variable life insurance, it's also true of our variable annuity business and of our retirement business. We also have our own broker-dealer. So we have a need for this type of investment research and expertise to be embedded within our organization, while most other insurance companies would prefer, again, to pay an outside organization to provide this service for them. We feel that this is a significant competitive differentiator because we recognize that the needs of the investment menu of a VUL may be different than the investment needs of a variable annuity. SURGE being embedded within our enterprise also recognizes that, and they allow us the ability to partner with them to optimize the investment menu that we make according to the product in which it's being housed. So again, this is one of the single biggest things that we feel demonstrates how we take the investment component seriously. From there, the brochure simply asks for producers and clients to each answer one simple question. For the client, it is, what is your appetite for risk? And that risk can put them into the bucket of growth, moderate, or conservative. And for the producer or advisor, we ask them, what is your preferred portfolio? Or said differently, how involved do you want to be in the initial construction and ongoing maintenance of the portfolio? Some producers will say, I want to be very involved, I want to be somewhat involved, or I don't want to be very involved. Once you have these two answers, we take an investment menu of the roughly 50 plus options that can sometimes seem inundating or a bit overwhelming to try to choose from, and we make it much more manageable and easy to access. For clients that are uncertain of their risk profile, we actually offer an embedded risk tolerance questionnaire. They answer a few simple questions, you score them, and their aggregate score will tell them which of those 3 risk profiles they fit into. And for the advisor that says that they want to be very involved, we allow them to build a custom portfolio where they can use any one or combination of our investments in any blend that they see fit, assuming that it aligns with their client's appetite for risk. We demonstrate this by showing the different investment options broken down by broad asset category, and you have 0 restrictions in the manner in which you choose or combine these different investments. The other end of the spectrum is for the advisors that say, I don't want to be very involved in the construction and maintenance. I would prefer to delegate this to a proven professional. And this is where you would use our asset allocation options. This is where we would offer our turnkey, off-the-shelf, ready-to-go diversified portfolios. And we demonstrate this by showing them in a hypothetical risk-return spectrum broken down by growth, moderate, or conservative, and then even from most to least aggressive within them. Finally, we have what I consider to be the Goldilocks scenario. This is our guided. This is for advisors that maybe want to operate from a blueprint or a template, but they still want to maintain some degree of discretion and autonomy in that portfolio. This is where we offer them the suggested ranges of broad asset categories, and then we provide them with a sample portfolio to demonstrate what that might look like. And we do so for each of those three risk profiles that the client has been assigned to. Finally, the brochure really discusses the intersection of the product and the investment utility, things like allocated charges, auto rebalancing, and DCA options. The point in walking through all of this is that one of our single biggest differentiators, and the reason that we've grown to be number one in this marketplace, is not only do we offer competitive guarantees, but we also offer, in many instances, the greatest degree of cash value accumulation inside of these policies. Said differently, with a solution like VUL Protector, you can offer a guarantee that can persist all the way up to a client's lifetime at age 120, while still having the upside potential of the capital markets without the downside impact to lapse. We are really allowing you to have your cake and eat it too. And in the current environment that we're in right now, because of that investment prowess, because of that insurance expertise, because of the direction that we have gone as a company, we are actually in a position where we have not only the most competitive guarantees on our VUL solutions in many instances right now, but we combine that with the most cash, and it has become a no-brainer for a lot of the companies and a lot of the producers with whom we partner. Beyond just product, there are other reasons that we've really grown in this marketplace, and I'll address a couple of those. The first of which has to do with our underwriting. I know that there's a tremendous amount of support that you have through Agency One, but Prudential has obviously a few unique niches within the underwriting arena that has really allowed us to build up a lot of market share. We've also made doing business with us extremely easy with things like Proof Fast Track and accelerated underwriting that allow for a more seamless business placement. Lastly, one of the things that has allowed us to gain a lot of market share has been the introduction of a tool or a system called Life Insight. Life Insight is a tool that really is going to look, feel, and behave a lot like traditional financial planning software, because it allows for you to see how your policy is performing relative to the assumptions that you made when it was placed. Again, it's going to look very much like the traditional retirement planning software that many financial advisors are familiar with, but instead it does so through the guise of their variable solution, which was one of the biggest challenges, one of the biggest impediments to sales in the past, has been that advisors and producers felt it challenging to monitor the trajectory and the progress of their VUL policies. And Prudential has made meaningful investments in infrastructure and technology in order to offer that solution, in order to offer that capability to our advisors and producers. So with that said, I'm going to turn it over to Kathy momentarily to see if they want to speak more to Life Insight, or if we want to go to Q&A. But to kind of put a bow on the comments that I made, I guess we'll put them into three buckets. The first is that the industry has made very meaningful strides in the way that we manufacture products. And Prudential has been a big participant in that kind of re-engineering of the VUL marketplace. In doing so, we've also really differentiated ourselves at Prudential as being that company who not only offers you the insurance solution that your clients are looking for, but we also make sure that we don't do it at the expense of being a true variable and a true investment vehicle. The last thing that we talked about was some of the ancillary reasons why you would want to consider partnering with Prudential, and that's where Agency One would absolutely be a wonderful partner for all of you in determining if any of those made sense. So, Kathy, that's all that I had for prepared remarks, and I don't know if we want to speak more to Life Insight or if we want to open up for Q&A.
So I've got, thank you, Joe, that was terrific. So before we go to Life Insights, and we asked Dennis Bartos to join us in this conversation for a specific reason, I've got two areas that I'd like either you or Brett to address, and we're going to attack them head on. And the first one we're going to attack is guarantees. So, you know, I opened up this presentation saying folks are looking for guarantees in this uncertain marketplace, and it is not, it does not go without notice to all of the attendees on this call and to the Agency One advisors with whom we're privileged to work, that Prudential gave us a major stomach ache in the past 10 days with your pulling of your GUL product. And, Prudential has been a carrier that we've relied upon for guarantees. And we're talking about guarantees with the VUL protector. We're talking about the SGUL. We're talking about the SVUL. How committed are you to this guaranteed space? And what sort of comfort can the advisors take when going out into the marketplace now saying, I'm standing behind Prudential and they're telling me that they have guarantees that are not going to go away? So somebody please address that.
Brett,
Joe, do you want to?
I'll go ahead and I'll take that one, and then certainly if there's any comments you'd like to add to it. But Kathy, it's not only a great question, but it's a timely one. Right? We just recently announced that we are going to be suspending the sales of our single life guaranteed universal life product, and that was an area where we were a market share leader for a number of years previously. I guess that I'll address that a couple of ways. The first of which is pointing out that we are still offering our survivorship guaranteed universal life product. So we did pull the single life version, but the survivorship GUL is still available. For those of you that may be wondering why that is, there are just certain economics that are structurally different between a single life and a survivorship product. And the interest rate environment that we're in, and interest rates are the single biggest influencer of the GUL pricing. At this time last year, we were roughly double where we are, if not more, on the 10-year Treasury. To give an idea of where we stand in the current interest rate environment, the 10-year Treasury has been hovering roughly between 60 to 70 basis points since the COVID-19 environment has begun. And that just placed such a downside challenge to us in terms of pricing on our GUL that it got to a point where it was not a viable solution for us to continue to offer in this environment. The good news to that is twofold. The first is any business that we have placed on the books previously was done under the pretense of the interest rate environment that we were in at that point in time, which means that you should have zero concerns about our ability to make good on those guarantees. Those products were built and priced to be able to withstand future changes in interest rates, and we've pulled our product off the shelf because of current interest rates. So those are two entirely separate issues there. If anybody needs any degree of reassurance, Prudential is a 145-year-old company. We have been writing checks to our clients longer than Social Security, so I would not be concerned about us not making good on those guarantees that we've made. So again, we haven't pulled the survivorship version. The single life version just has economics that didn't allow us to continue to offer it, but I would not be concerned about our ability to make good on the guarantees that we've made to previous policyholders. And then the last piece of it, and it was really the reason why we felt it was appropriate to pull the product rather than repricing it to be so expensive, is that we have our VUL protector. In many instances, even before this, VUL protector was cheaper than GUL. Said differently, you were getting the same guarantee at a lower price point, and you had the potential for the cash value there. Again, that was the have your cake and eat it too remark. That was the ability to make sure that we're not only offering the insurance component, which is that guarantee that can be dialed up to age 120, but you also have the cash value component associated with VUL. Even before we pulled the product off the shelf, we were seeing tremendous transition and adoption of our VUL protector, because a lot of people were starting to realize that, hey, if I can get the same baseline guarantees, but I can also get a lot of other really cool features associated with VUL protector, they were making that transition long before we pulled the product off the shelf. So that's a bit of a long-winded answer, Kathy, but I wanted to be exhaustive because it is an important one, and I hope that addresses what you were looking for.
It certainly answered my question. Brett, is there anything that you would like to add?
Well, Joe, I'd just like you to talk about, you talked about the difference between SUL protector and UL protector. Just hit the difference between VUL protector and UL protector and the reasons why they should take comfort in the fact that we are committed to the guarantees in that space versus the UL protector, if you would.
So when it comes to the difference between single life and survivorship, there's different economics, there's the different factors that go into building those products. There's also different economics and different factors that go into adding guarantees to a variable product versus a guaranteed universal life. When you're manufacturing a guaranteed universal life product and you're really building it out from a product development standpoint, you have to use interest rates as your baseline assumption in order to reserve against the guarantees that you're offering. within a variable product, instead of interest rates, you're replacing that with a slight exposure to interest rates, but really it's more about the capital markets being the influencer of your reserving requirements. Because the interest rates are so low right now, it's a lot more easy to make assumptions about the long-term returns of the capital markets than it is to make assumptions about the long-term returns of interest rates. So we can more easily offer the guarantees that we are and reserve on them appropriately while still making a profit and delivering value to consumers in a variable product than we can in a GUL. Brett, was that kind of what you were looking for?
Yeah, absolutely. Absolutely. That's what I was looking for, because we're comparing the single life product to the single life product there. And I think you did a great job of explaining the differences there and how the products are built and why in one case we had to pull the single life no lapse guarantee UL protector versus staying on the market with the market on the VUL protector. So thanks, Joe. Appreciate that.
Terrific. Thank you. That was a very thorough explanation and certainly answered my questions. But now let's get further granular and let's go head to head between Prudential and Lincoln. So let's talk about how the protector product compares to the Lincoln VUL1 product. Joe, the floor is yours.
Thank you, and that's another great question. And frankly, at this time, maybe a year ago, I was in a lot of situations where people were sitting three solutions side by side, and it was our UL protector, our VUL protector, and Lincoln's VUL1, because they all did offer those wonderful guarantees. It was then drilling down a little bit further, Kathy, to your point about what is the right solution. So the difference between VUL protector and VUL1, I guess I'm going to answer this a couple of ways. The first of which is that Lincoln is a wonderful company. They were an early entrant into the space. They built up a market share lead early on because they were amongst the first to really offer and market a guaranteed VUL solution. And they deserve the sales and the market share that they got. And Lincoln is a wonderful insurance organization. What Lincoln did in manufacturing their product was they really built out a product that was price sensitive, meaning you won't see the same degree of cash value accumulation, but for a number of years, they had a pricing advantage. Lincoln essentially, and I've heard some people describe it this way, and I don't love it described this way because I do occasionally feel like it has a negative connotation, but Lincoln had, in some people's opinion, built a GUL in disguise. They essentially built a GUL on a variable chassis, and the reason that it was viewed that way is it's not until you get into 8-9% rates of return consistently that you would see material cash value growth within their variable product. That said, the trade-off for them had long been that they were priced extremely competitively for a lifetime guarantee. So at this time a year ago, what the comparison that was being made was, hey, you have Prudential, who might cost just a little bit more, still an extremely competitively priced guarantee, but maybe we cost a little bit more, but we were building cash value at 5, 6, 7% rates of return, and that offered flexibility in planning, that offered an exit strategy down the road, that offered a number of corridor increases, which is where we increased the face amount of the policy because of how much the cash value has grown. So the death benefit at time of mortality was often higher than Lincoln. So you kind of had a really nice yin and yang to choose from at this time a year ago. We've received a little bit of a tailwind recently where Lincoln has made some pricing actions where they've actually increased pricing on their VUL1. And that's what's put us in the position now where we are not only more competitively priced, but we still have that cash value advantage. That's why we've seen so many people transition from Lincoln to us, because it's no longer a decision of, do I want a slightly cheaper guarantee or do I want the potential for cash value? You're now actually getting both with us. So again, that's not to dismiss Lincoln's solution. It's not to say that we're always going to be the most competitively priced. It's just at this point in time, we happen to have both. But we have always decided that where we want to hang our hat is being competitively priced, but more so having that cash value to boot.
Terrific. Thank you. We've got two things left that we're going to cover. And before we turn it over to Tim, because I do want to talk about life insights and policy administration, because it's going to make every advisor's life easier once the policies are put in force, and it provides tremendous value to the clients. We really have to talk about how you can place your variable business with Agency One. And for that, I'm going to turn this over to Dennis Bartos because we work with advisors all over the country, placing their variable business. And a lot say at the very beginning, well, I didn't know that that was an option. So Dennis, why don't you explain how this works and what the concerns are and how we solve the concerns?
Absolutely. First, we do this all the time. Agency One acts, my registered broker dealer is the Leaders Group, and we act as a wholesaling broker dealer, which means that you as an agent, you could be dealing with prudential underwriting for a fixed contract and suddenly shift over to a variable life contract because the underwriting is so good at Prudential, which it usually is. It doesn't mean that you have to change gears at all from Agency One to your broker dealer. What happens is your broker dealer remains in the loop because he has to. All of your compensation on a variable life contract must go through your broker dealer. That's a compliance issue, and I am the registered principal at Agency One, and I am the compliance officer. So I deal with your compliance officers all the time if necessary. Most generally, there is a selling agreement in place between your broker dealer and my broker dealer, the Leaders Group. It's a wholesaling arrangement. It's simply an acknowledgement that there are going to be commissions paid to the Leaders Group on top of the normal commissions that are paid through your broker dealer and then on to you through your normal dealer concessions. Okay, there's nothing unusual about this at all. All you really need to do is to tell me who your broker dealer is, and we will tell you right away whether or not there is already a selling agreement in place. If there is not one, we will put one in place, or we will get an acknowledgement that allows you to sell this case. If your broker dealer turns you down, then there's not a whole lot of options that we have, but that's entirely up to your broker dealer. But we really haven't had anyone turn us down because this is an underwriting issue that's involved, and it's a customer service issue, and doing right by the customer is something that all broker dealers want to do right now. And if I've got underwriting in place at the Prudential or Lincoln or John Hancock, and you want to sell a variable life contract through your broker dealer, we're going to make it happen.
Thank you, Dennis. So if you have any other questions regarding how you can continue to work with your broker dealer and have Agency One do the underwriting and get your variable cases placed, please feel free to reach back out to Dennis, myself, or to Gonzalo, and we'll be happy to further have that conversation with you. So now let's turn it back over to Tim, who's going to talk about life insights and policy administration. And I'm also going to remind everyone, if you've got any questions, please type them into the chat box, and we will be happy to address them at the end of Tim's comments.
Thanks, Kathy. I'll just spend a couple minutes on this. I know Joe alluded to it earlier in his presentation about Life Insight. And this is a great tool that really separates us from our competition. I know when you're dealing with variable policies, really in-force management is a huge concern for a lot of people. So what Life Insight is, it's really an up-to-date policy information tool that you can go in there. So if you have a variable contract, you can go in there and actually get real-time data as of the close of business yesterday. So wherever the market's ended, you can go in there and look at your client's policies, see cash values that are in there. And the really nice thing about it is you want to manage their performance over the life of the contract. You can go in and do that as well. So you can actually set up, let's say, a baseline performance that you want to make sure that your policy is performing, your clients wants to perform at a certain level. You can set that baseline illustration up, save it into Life Insight, and then you can go back in, let's say you're doing an annual review. You can go back in and then run different type of comparisons and see how your policy is actually performing now versus the baseline. And also, let's say the market's going to do really well. What if the market's doing 7, 8, 9%, and you want to see that too? So great tool for going in and managing your book of business. We also at Prudential do a lot of what we call loan rescue. And if you're taking over a loan from another carrier and bringing it over to Prudential, you really want to be able to manage that loan and how it's being either repaid or performing. A great tool, again, that you can go in there and manage your policy performance within this. Another great benefit to this is a lot of the forms that are sent out to the clients are stored within Life Insights. You can go in and pull up, quarterly reports, annual statements. They're all stored in here as well. And I know another big thing too, when we're talking about, Joe mentioned our accumulation product. If you're looking at a product where you really want to build a lot of cash value in there for income purposes down the road, you can actually set reminders in here as well. So let's say you know that in year 10 or year 20, you want to change that death benefit from option B to option A, you can actually go ahead in Life Insight and set reminders in there to remind you to when to go in there and do that. So again, a great tool. Want to give you a little hint, a little piece of the pie here to pique your interest. We actually talked about doing a live demo of this with Agency One, so it's something we'll probably try to get on the calendars here pretty soon. My internal does a great job actually going through a lot of the different pieces of the puzzle here. But again, just a state-of-the-art. I think no other carrier has a tool like this at their disposal to help you manage your book of business. So again, we're really proud of this piece. It should give you as the producer the confidence to go out and sell variable life or any of our products really, but being able to go in there and really manage it on a real-time basis, something very unique in the industry and that we're very, very proud of. So Kathy, appreciate the time. I just want to spend a couple minutes on that. Joe and Brett, you guys did a great job. If we have any questions, we can open that up now.
Hey, Tim, does Life Insight also work for non-variable products?
Yes, we are now rolling that out. So we do have our index products on here as well. Founders Plus, probably our most popular, which is our Death Benefit Protection IUL. That is on there, as well as we're about to launch a new Accumulation IUL, kind of a preview, next month. So we'll have a new Accumulation IUL that we'll be able to have input and loaded onto the system as well.
Terrific. Well, I don't see any questions that have come in. So at this time, I want to thank Brett, Joe, Tim, Dennis for what I believe was a terrific presentation. There are your clients have choices. Agency One is here to help you navigate through those choices. Prudential has always been a terrific partner of Agency One. We are happy to represent them and to introduce you and your clients to the opportunities that are available to help them, as Brett said, complete the dream. Hopefully everybody is still dreaming in this environment that we're living in. So with that said, I am going to conclude this webinar. Again, thank you, gentlemen. I hope everybody has a great rest of the summer. If anybody has any questions, comments, concerns, please feel free to reach out to your team at Agency One. We remain ready, standing ready to help you with all your questions and